Australia is going to do very well. I think we've weathered the whole pandemic relative to a lot of other countries a lot better. I'm very bullish commodities. I think the word super cycle is getting thrown around a little bit. Shorting, it gets addictive, right? Because the downside normally is far faster and more aggressive. If it's falling, people panic, and then you can make a lot of money very quickly short selling.
All right, well, we've got Scott Williams today. Scott's the CEO and CIO of Fiftyone Capital. To give you a bit of context, a couple of years ago, I did a presentation as part of a conference with Darren Reed, who's one of the members of Fiftyone Capital. I was really impressed with what Darren had to say about how his fund, Fiftyone Capital, fitted into the sort of ecosystem of the macro fund, of the fund management industry or the hedge fund industry. I liked his control, how they went around looking at the world stock selection, having the flexibility to have long positions, but obviously look at short positions as well, should the need arise. I loved the control around risk management, and I was really infused. And I thought, given that we've just recently rolled out equities on a global basis, and given that short selling has been very much in the news, and that the hedge funds have been very much in news as well around degrossing, but obviously a major part of what we're seeing. I thought it'd be great to get Scott on board. As I say, Scott is the CEO and the CIO of Fiftyone Capital. He is very different from myself because he looks and manages money. I think that's really important given what we're seeing at the moment with this sort of consistent bid that we've been seeing in markets. So great to have you on, Scott. As I say, I'm a big fan of the fund and what you guys are doing. So just before we sort of get into the hedge fund industry, why don't you just tell us a little bit about, from your perspective, what Fiftyone Capital does, the objectives, who your clients are, and then maybe get into some of the performance as well.
Yeah, Fiftyone Capital, I set it up in April of 2018. So we're coming up to our 3-year birthday very shortly. So that's quite exciting for the team. So we set up as a global long short manager. So we trade global equities. We run an absolute return strategy, absolute return being, no set benchmark. We just aim to generate double-digit returns for clients and try and limit drawdowns. We really have a focus on capital preservation, and I guess we'll talk today a bit about how we use, short selling to limit drawdowns and preserve that capital, and then focus on the growth aspect of the fund as a professional money manager.
Great stuff. Now, I saw in your January update that the fund, since the inception, as you say, back in 2018, had had a return of 60% over that period, which I looked at the total return in the MSCI World Index, which is around 42%, the ASX, which is about 31%, the S&P a little bit more. So relative to whatever benchmark you're looking at, I'm sure maybe one of those benchmarks is in the mix, but 60% is a pretty amazing achievement in that period. What's been before we go into sort of the markets and the strategies in there, what has been your secret sauce effectively for the outperformance you've seen in that period?
The markets over the period, since the fund's inception, we've seen 2 of the biggest drawdowns, in history. In particular, COVID-19 was a major drawdown.
Sure.
So, I think one of the key drivers that allowed us to outperform was, mitigating losses during that time. The market, we were actually nearly up during that period, and only gold really sold off. And I guess we can talk about how we sort of looked at the markets at that time. That's probably been a large contributing factor. We, I guess, have really solid networks, not only in Australia, but through recent hires at the fund in the US. We've been able to, catch some trends really early. We've been big believers in gold quite early. That played out very nicely. Uranium as well. That's added a lot to performance, and also a few little micro stocks. I mean, Paradigm being a small biotech in Australia, that added a lot of performance to the fund in the early years. And the way we, I guess, construct the portfolio for smaller businesses, below a 500 mil market cap, we tend to limit the amount of exposure we can have to those sort of stocks just due to that volatility and, as I said, capital preservation and how it fits into the overall portfolio. But in those smaller ends of the market, you can see quite material gains if you pick the right names, but they do come with added volatility, and it's about managing risk in those positions, and hedging out downside can be quite difficult. So we try and use that as a small component of the portfolio. We've certainly had a lot of, multi-bag returns from several stocks in that sector, domestically and overseas. And that's all added really nicely to performance. So, we just try to keep doing what we do, and I guess secret sauce is really just looking at markets and trying to construct a portfolio in a way where we can mitigate downside risk and try and capture upside. We really like to allocate money in asymmetric ideas. So if you think about like playing poker on a really good hand, and a lot of people in the hand, and you've got the nuts, you're going to win. You want to push all the chips in and try have a lot in those positions. So the things where we have really high conviction and have done a lot of work, either have an edge in terms of analytical information or time. Those are the trades that we like to size larger and really ride through. And that's where I think the performance really gets driven. That's really where we add a lot of alpha.
Yeah, alpha's the key there. But just going into the actual hedge fund industry, because I'm sure there's a lot of people who are watching this who are really interested in the hedge fund industry and how they work. But so give us a sense of, I know there's different objectives, long short funds, risk parity funds, and various factors, high frequency. Give us an understanding about the hedge fund industry, the sort of size, the scale, the growth, the use of leverage for their positions, and then ultimately, as you say there, how Fiftyone fits into that sort of ecosystem.
First rule of the hedge fund industry is we don't talk about the hedge fund industry.
Yeah, right. Okay, fair enough. Yeah, it's true.
I think there's a lot of shrouding, and I guess it's quite a mysterious, industry, and it's always in the news, and they can be portrayed as the bad guys, and they always I guess, agitating for change. And there's a whole range of different guys that run, long short strategies, or hedge funds as they're more typically known in the US. When I set up the fund, I looked at, obviously markets go up and down. So, why only make money when they go up? When I was broking, one of the biggest peeves was really, the market would fall. Clients would always ring up when markets fall, there's fear in the air. And there's no way to capitalize that or protect yourself. And that's really, when I thought, long short is such a better strategy, especially, I believe the market's a pretty late cycle, and we may go into a period of, it could be years, or, hopefully not like Japan in decades of, sideways to down markets and very difficult. So if you can't short sell during periods like that, you're really limiting the ability to make money. But, in the current market, it's really, bull market on the upside. That's where you're going to make money. So why limit yourself to one? The other thing was, in global equities, there's far better companies around the world than just in Australia. Sure, we have great networks here, and there's potentially a lot of return that can be made domestically, and certainly people do that. But, it also comes with added risk. And if Australia is going through a period of, recession or downside, relative to, say, a Japan or a US or a Europe, why limit yourself to just investing there? So, we are classed as an absolute return global long short fund, but there's obviously domestic. There's other guys that use a lot of leverage. So the way I set the fund up is we normally don't like to use a lot of leverage. So that can be leverage on your long book as well as short selling. So just to use as an example, to try and put that in context, if in the portfolio, if you were short selling 100% of your portfolio, you get the cash. So just use an arbitrary number of 100 million. You sell $100 million of shorts into the market. You've now got 100 million cash. You then can buy $100 million worth of stocks long. Your actual exposure to the market is 200%. Starting your 100 million, you now have 200 million of capital in, but your actual exposure or net exposure is zero. So there's other things like that called market neutral funds. Market neutral try run, in a band. It could be 10 or 20 or 30%, either net short, net long. We don't really have any constraints like that or any set guidelines. We'll, really absolute return with free flow as we see the market. But there's obviously a lot of guys that can run even bigger than 200%. You could use, and leverage up your short book and do 200 short, 200 long, or 300 or 300, so it's 600. And when you run things on leverage, if they go the wrong way, they can be really good on the upside, and you can make a lot of money, or you can make a lot of money on the downside. And I think hedge funds, when looking at returns, that stuff needs to be considered due to the volatility of their returns. So we try we try and limit our drawdowns and volatility, and we don't use a lot of leverage. But if you're comparing apples and apples, and you look at, say, our fund and someone that's leveraged, 300-400%, and we're not even 120, and we're keeping up with that. We're taking far less risk on our capital to generate similar returns. So we try and focus on being less leverage. Obviously, I've got substantial investments in the fund myself.
Yep.
We don't like to risk it all. And as I said, it's capital preservation first, then return. So in markets that are, conducive to growth now, that's been really good for managers, I guess, being skewed long. But obviously, as you saw recently with some of the short selling, shorts can go against you and really burn returns as well. So it's a very diverse industry with lots of different strategies, obviously like quants and other things. But yeah.
I just want to touch on that short selling thing before we go into markets, because I'd love to tap your view on what your fund's doing, or at least what your thinking is at the moment in the current environment. But you talk on short selling, and you have the flexibility to go on the short sell if you see the opportunity. And I love your ethos of your mentality of when, not if, and we'll touch on that again in a touch. But just talk to us a little bit about short selling within your fund, the process that you have in sourcing short selling, and how active you are, and the constraints that you've got around short selling in this current backdrop.
Yeah, sure. I guess, when you look at a hedge fund and the returns, the way I sort of describe it to people to try and make it simple is, if you were a building developer and you were doing buildings, and you didn't use or take insurance, right? So you weren't paying a premium way on insurance or trying to protect your development, you will always make more money. So all the hedge funds that you see, that run and short books, depending, the upside, they typically will capture, say, 70% of the upside, but they've got that insurance policy. When you look at the returns when the market falls on average, the falls are significantly larger than, because your hedge should kick in. So we look at the markets and we think about that all the time. When is it a time to put on more insurance? And unlike a builder building, if a cyclone's coming, obviously an insurer is not going to take we're not going to let you have insurance, you know what I mean? But if you could pick and choose when you put it on and off, that would be a significant benefit. So if there's times where, say there's riots in the street and your development could get, impacted or burned down or something like that, you might want to take a bigger level of insurance to cover yourself. We probably think about our portfolio in a similar way, looking at how, so to premise that, in the current environment, you make far more money on your longs, and the shorts really protect downside. So in the current environment, if we talk back to COVID, we managed that very well due to shorts kicking in. But then when the market continued to rally, it was probably around middle to late last year, we sort of saw there was no fundamental rhyme or reason into some of these names. Just as an example, like some of the travel stocks trading at pre-COVID levels after all the capital raisings and things, even though earnings are down 90% and certainly aren't bouncing back this year. Next will probably start to trickle. There probably will be a time when it will go crazy, but retail money, free flowing money going into things, it made it quite difficult to short. So we very much moved away from single stock shorting aggressively to focus more on hedging using indexes or options or index futures, I should say, to protect the overall portfolio and how much we thought it could move in those times, which has proven to be a very smart move, because the markets continue to rise higher. And if we'd run an aggressive short book, we probably wouldn't have returned as much as we had recently. However, going forward, there will be a time when we will start to build our short book up more aggressively and hold longer term positions as a lot of this money or tapering comes into the markets and does start to unwind. Which is probably moving into the next part we want to talk about.
Well, I think for me, I actively short sell stocks. But I'm like you. I mean, I look at the market conditions, and I like to see a situation where you get a scene unfolding, and the market's saying, you can see the bid dry up, you can see markets aggressively moving lower, you can see implied volatility pick up, and there's a lot of uncertainty, and the market's looking for questions. Well, they've got questions, they're looking for answers, and they can't immediately know what those answers are. That to me is when I use shorting quite aggressively for short-term moves, because you get those aggressive sort of downward boost, I think that's the
I
perfect
think
time. Like you say, we're not
you hit
seeing
the nail
that.
on the head there. Shorting, it gets addictive, right? Because the downside normally is far faster and more aggressive than on the up. The S&P could be up 20 bips, 50 bips, 1%. It's ticking along. You get a bad night, it's off 3-4% in a night sometimes. And if it's falling, people panic, and then you can make a lot of money very quickly short selling. And I think that sort of gets a lot of attention when those moves come. But it's a lot more than just that, I think.
Yeah, well, I think you've got to look at the backdrop, and when you see those conditions pick up, I think that can be a ripe time to take advantage of short-term moves. But the system, in my mind, is set up to go long at the moment, and we talk about global equities because that's your bag. But global equities, they're all-time highs. Fiscal, we still got a lot of fiscal support to go into US markets. Both on the infrastructure and the relief package, which is still to be voted on pretty soon. Central banks are still pushing back on this notion of tapering. They're still incredibly accommodative. Volatility's picked up a little bit, but it's still fairly subdued. So in terms of global equities, and we've just seen an incredible earnings season in the US. I mean, 65% of companies have beaten expectations by one standard deviation, which I think is the best earnings season from that capacity in nearly 30 years. In Australia, we've seen beats outperform misses by some fourfold or so. So it's been an amazing earnings season. But what's your take? It sounded like a loaded question. I feel like I'm putting words in your mouth. But what's your take on global equities right now in that situation?
No, look, I tend to agree. They've said pretty much since the GFC, don't fight the Fed. And I think if you look at the other night, the volatility in the market. We come in and I talk to Nick, who does a lot of our US hours. What happened last night, I had a little go, and it seems like crazy is the standard response. The other night, I think the Nasdaq had a 4% swing from low to high.
Right,
on Jay Powell just coming out and saying we're going to continue to support markets, rates. Inflation is fine, rates are low, print more money, and there's walls of money and stimulus going into the market. So as we had said, it's pretty risky to try and fight the Fed on the short side and try and take a view. And if people aren't using, just shorting because something's expensive is a very dangerous game to play. And we sometimes get caught in that. I think everybody's does that. We look at valuations and do put that factor it into our models and things when we do take positions. However, in this market, there's no if there's no rhyme or reason, or there's no there's no fundamental drivers. There's no reason the stock can't go from 10x overvalued to 50x overvalued, and some of these things have done. And I mean, look at a GameStop as a perfect example, as we've been discussing off air. Just get squeezed and run up. And I mean, short sellers get a bad rap because everyone thinks, oh, you're betting against the market, you're betting against companies, you're betting against people. But the reality is, if you're wrong, you have to buy back those shares higher, and that's exactly what happened on things like GameStop. So I'm pretty, I guess, flat in my view with it. I obviously do short sell as well, but believe me, being on the other side and having to buy it up higher, sell high, buy it back higher, happens a lot. And I think that driver in the market, people as the retail hordes have found out with GameStop and others, and were squeezing it. It was a very dangerous time to be shorting a lot of these things, because typically those businesses aren't very good businesses. They're fundamentally flawed. They have declining revenues, profits, margins, and they're typically a short that we would like to hold. But in this environment, there's no rhyme or reason as to why a stock like that would go from $10 to nearly $500. So you're fighting a dangerous game.
Let's talk about materials are working really well. The reflation vibe going through markets, we've obviously seen that in the backup in long end yields. I'm not sure if you talk about like some of the holdings that you've got in the fund at the moment, but what are the sectors that you like the look of at the moment within ASX and global markets?
I definitely think that the value trade is probably where you want to be. I'm very much of the view, you make your best money buying things that people hate. And we, look at uranium, we were buying that. Everyone was saying it's rubbish. And I mean, the price hasn't moved, but a lot of the equities have. Gold again. I think the value trade is probably going to do better in the period ahead. I do see potential for inflation to rise. I don't think the Fed will be able to handle it. And I think buying things where you have a cushion on the valuation is better. owning something that's gone from, I was laughing. There was a guy, I think they were saying, things will normalize and companies will go from trading on 30 to 40 times revenue to 10x. And even 10x was insane back. I don't know if you remember the GFC. You couldn't even buy things on 10 times PEs, let alone 10 times revenue. So I think that part of the market is quite frothy, and there's a lot of sort of bubbling away in that tech growth. And probably, as you said, in the reporting season, was that the best reports they've had? Or was that the most people are going to rely on technology? We could be doing this face to face and not over Zoom. So, are we going to move away and be less dependent on it? Do we want to get out and do more things in the brick and mortar? And I think people forget, in inflation environments, which certainly are happening a little, there's a fear of missing out or risk in that I need to do it now, I need to buy it now, otherwise it's getting more expensive. And lumber is a good example. We had a big position in a Canadian lumber company. Timber prices were going up, and we were hearing stories, even domestically in Australia, of builders saying they were stockpiling lumber because they thought the price was going higher. So, and then you fast forward 12 months and maybe the price is up 30 or 40%. Now they've got to pay 30, 40% more, and they're passing it on to their customers. So I do think inflation could rise, especially with all the stimulus and money, and probably the pent up demand from being locked up at home. And, Australia's been a big beneficiary, I guess, of not being as locked up as Europe and the US and other regions. So, what will happen going forward? My view is, I think value will come back. I do think we'll see a lot of these growth names probably sell off. Things like, tangible assets, oil, copper's obviously having a really good run. The reflation trade. I do think real commodities is probably the next area that'll do well. And we've certainly been positioning into a lot of those sort of names and things that will benefit from that as well.
Yeah. What do you think? If I look at the Australian economy, it's obviously clearly on the mend. Business confidence is moving up. Consumer confidence has had a move up. The market's toying with the idea of earlier than guided by the RBA rate hikes. What are you doing with the banks? Have you got any exposure to the banks? Do you like the banks? They've done very well this year, but do you think they continue to go well, or would you think they're sort of plateauing out?
I think in a rising rate environment, they will continue to improve. I think our clients, they typically pay us to be a bit smarter than just buying bank stocks. They normally, might own those anyway. But it's not something that we're heavy in. I do think that it will be favourable environments going forward with rates going higher for banks. Obviously property going up, and in an inflationary environment, people do, tend to want to draw down and use debt, which depending on how much inflation runs away, it could get dangerous for them. Because obviously if inflation's devaluing your currency, having a lot of debt's not great as a bank. So, look, it's not our core area. I do think that they're probably doing better in a rising rate environment, and there's certainly a lot of demand domestically for property. More so now. I mean, Western Australia, I can talk from experience here. It's been in the doldrums for 10 years, probably since 2012, 13, when the resource boom, popped. Right now, iron ore is back to records. Twiggy paying himself 1.4 billion in dividends. There's a lot of cash flow in the state. So, and a lot of people that own those sort of shares that are getting, big dividends, mining, wage pressures going up. They're spending in property. There's a strong demand for it here, and I think Australia is going to probably, be in a good period ahead of it. I think, we're a very commodities-driven nation, and there's other countries spending on infrastructure. I think the trend will continue here. So more lending, more money, more banks, more wages should be, beneficial, I think, around.
Yeah, no, I think so as well. And I think obviously you get a total return from the dividend. I want to go into the strategy because there's two focus points that I want to look, or three major focus points that I want to touch on. One is, your strategy of managing drawdown. You've talked about short selling, but your long book that you have, let's say the long book's performing, you get a little bit edgy about the volatility picking up, you think there might be a bit of a market drawdown. What's your process of managing that drawdown? Do you have the shorts in place? Do you have the index shorts in place? How do you go about looking to mitigate the drawdown in that portfolio?
So, I mean, the investment team meet on a daily basis, and then the investment committee on a monthly. So we're constantly reviewing positions, and our core holdings, as I said, the things that we've sort of shoved the chips on, we tend to like letting those run. So normally we'll work out how much risk we think is in the market in terms of a potential volatility event or fall, and then how much beta each position has into the market move. So if the market is going to drop 5, is this position safer, or will it drop 5, or will it drop 10, or will it drop even more than that? And then we try to work out by putting on right now, the way we're doing it is focusing on index hedging or using options to try and offset that. Options being you're going to lose the principal that you put on it. And we've put on some options hedges in the last couple of months. I think I had discussed that in my newsletters as well. And that it might be 30 to 50 basis points with a 5 to 15x payoff. So you're risking, say, 30 basis points to make, I don't know, let's just call it 1.5%. That risk, so we lose that principal when the market continues high and the options expire worthless. But it did protect it if it fell, because we may look at the core holdings and say, well, we think they could drop by 1.5. There's no exact science to it. It's very difficult, and markets change, as you know. And if you look at COVID, things went far further than we could have thought. It is very difficult, and it's sort of on a case by case basis. Like I was using the example, if you were long FMG for iron ore exposure and thinking, iron ore might have a little blip now and then it will continue on its merry way, but you don't want to sell your FMG because you want to hold it and you don't want to crystallize capital gains. You might short sell some Rio or another iron ore exposed business that may fall, and maybe Rio can fall as much as FMG, so you need to short double the amount. And then when you bank that profit, you can always just take the cash and buy more FMG on the dip. So when you're covering your shorts and converting them into cash again, the profit can be reinvested into your best ideas.
If you've got a long position, and I think this sort of comes into what a lot of our clients would do, the understanding of being wrong. So let's say you've got a long position, you haven't hedged it, this might be slightly uncorrelated to the portfolio. And it might be in a sort of standalone area that you're trying to express a thematic on, which maybe, as I say, be isolated. But then that stock's not performing. Do you hedge that position, or is there a mechanism in the fund? And I want to sort of bring this back to what retail thinking about holding on to losing positions. Is there a mechanism that you have that says, this just isn't working out, let's get out of this and let's take the loss on this?
I mean, I can give you some examples on both sides. So for example, if it's say a smaller position, it's a lot easier to, you're not as attached to it. It might be a starting position. If it falls, you can always sell it and buy it back, or buy it back if it's a short. If it's a more core position, it's always a bit harder, I find, because normally the portfolio manager, or, you've done a lot of work on it, you have more conviction. You sometimes can sit through the volatility. Normally what we do is we'll assess it as a drawdown risk to the portfolio. So we might set levels whereby, okay, it's gone this far against you, you have to just reduce risk so you might have to cut 30% of the position just to make it smaller. If you look at our performance, our worst month was actually January of 2020. Now, that was before coronavirus, and it was a short position that we held, and we were, confident on a short in Tesla. And we were saying, this thing was overvalued, it had gone up materially, it was crazy, and then it doubled and doubled again, and it just kept going against us. That position was very difficult to manage because it was more of a core short that we wanted to try and hold, and we thought the market was topping out. And then obviously coronavirus happened, and it sort of saved us a little bit in terms of being able to scale the remaining position and exit. However, that was a painful period because as the stock, if it was a 2% short, so it starts off relatively small, and I say core position at 2%, because shorting your losses are infinite. That stock doubles, turns into a 4% position, and then it doubles again, and it's an 8% position. So when we have limits as to on shorting in particular, how high it can go. So if it gets to a 5%, we would never let a stock be bigger than a 5% position on the short. And even that's probably too high. We normally try and keep it a lot smaller. As they get to there, you have to trim risk. So you trim it back to, say, you might sell it by half, and you're back to still a 2.5% position. And if it doubles again, you're doing it again. So it can be extremely painful. And as you saw with Melbourne Capital and GameStop, you can have material losses build when they move against you if you keep holding those things. So at some point you have to say enough's enough. And I laugh at that Tesla thing because I looked at the time and thought, this is absolutely crazy. Then they did the stock split, and now it's like 4 bags from that price, yeah, or 10 bags, or whatever the hell it is. It's crazy.
Yeah.
So,
no,
but
exactly.
you
I
can't.
mean, that whole situation has thrown the idea of, yeah. I mean, there has to be a time when you say that this isn't good, and I think you've got to throw in the towel. Just want to touch on when you're thinking about an idea and you've thought about an idea. And again, coming back to the idea of how we can sort of communicate this with retail, because this is something that everyone needs to think about, the idea of position sizing within the fund. So you've chosen an idea to go long. How would you allocate a percentage of your capital? What's your thinking around that?
So we look at it in terms of three bubbles really, and we try and look at, okay, what edge do you have? And us being moderate, small to moderate fund versus a BlackRock, do we have an information edge on Apple? Probably not. We can't pick up the phone and call Tim Cook or the CEOs of BHP or anything like that. We're not. And no one's got any real information edge there. Analytical edge. Sure, maybe we have a view and we can take a view on what iPhone sales are going to do, or iPad sales, or all the rest of it, or the cloud. We can look at different components of the business, or we can say we have a different time horizon. So if you have a very short-term time horizon and you only want, a catalyst trade and something short, we then say, well, each one of those bubbles, if you've only got one of them, you'd only put, say, 1% of your capital. This is our sort of thinking, around 1% of your capital into those, because what edge do you really have? You're just taking a trade, you can manage risk. And then talking about risk management, you might have simple rules like we never let any one position draw down more than 2%. So if you put 2% and it goes to zero, you're losing 2%. But if it's a 5% or 10% position, 10% position for ease of numbers, if it dropped by 20%, then you're gonna cut it back. So we try and size positions accordingly. So just going back to the bubbles, if there's overlap, so you might know you've got industry contacts and they're telling you we're selling more chips than ever. Things are looking really solid. So you've got inside sort of industry contacts that are giving you intel. I use the examples. We were in a company called Index. We went and saw the company. We're doing a site tour, which we do. Meet companies all the time and looking at things. And all the tools are on rent. Go down to the warehouse. Can we see the tools? Oh, there's none here. I'm like, what do you mean? You rent and sell those? No, they're all on rent. They come in, they go as quick as they come.
Wow.
So your utilization is like at capacity coming up from something lower. These are signs, and then you talk to other industry contact drilling. All the balance sheets of the juniors are the best they've ever been. Oh, we can't get drill rigs, we can't get equipment. So there's obviously demand and pricing pressure. So you can see signs like that. So you say, well, WA is locked to everyone else. No one else is in that warehouse looking at things and hearing, on the ground stories as much. So maybe we have an edge on that. How long are we willing to hold that position? What's our view on commodities going forward? Is that something we're willing to sit on for a longer period? Yeah, we think it's going to be a longer trend. We're not waiting for one quarter. We might sit on that for a couple of years. And then the last being analytical, like, is the stock cheap? Is the market factoring in these growths and changes? And then that position might turn into adding all the three, somewhere between the 3 to 5% position, if you've got all three of those components. So as I say, you're pushing chips in on something that you know more of. But if it's just looking at a chart or looking at a company, and saying, oh, I think this, without doing too much work, we tend to want to, or for clients, I would say, you want to size things smaller and manage your risk and know where your pain points are. But in the overall context of the portfolio, if you run the exercise and look, when you draw down, it is very difficult to build up from a lower capital base. So it's very important to manage risk and watch stocks and adhere to them. And it's harder doing on your core positions, because if you've done all that work and that stock goes down, then we have to fall back to those basic rules and say, well, okay, we've sized it at 5%. We're getting down toward 2%. Are we cutting this? Are we adding to it? Are we, we need to look at it and work out how the overall portfolio is looking. But generally, you have to rip the Band-Aid off and reduce the size of the overall exposure, which comes to that original point of, fund managers degrossing. And, when their shorts are going up and they're getting burned, they're selling down overall. They're taking that net exposure, down from 200 to 300% down, bringing it, more cash, less risk.
Yeah, I want to touch lastly on your geographical reach. So you will select investments and trades on it in a geographical sense. What countries do you like at the moment? And also when you have that position quickly, how do you manage the currency exposure on that?
Currency trading is extremely difficult. It's something I've never been amazing at, but it's very difficult, and I think you just have to look at long-term trends in those spaces. Obviously, look, I think domestically Australia is going to do very well. I think we've weathered the whole pandemic relative to a lot of other countries a lot better. Commodities, I'm very bullish commodities. I think potentially the word super cycle is getting thrown around a little bit. A lot of money printing, a lot of people going into hard assets. A lot of countries are looking at infrastructure spending, expanding, supporting getting jobs, unemployment, and the way they do that is you either go to war or you build things. So I can see a big amount of money moving toward that, and I think it's been an area that's been developed and underbuilt. So supply is somewhat constrained. So mining probably does really well. Higher prices, allow further development of other mines. So I think Australia and the currency will do well. We only focus on developed countries. So we typically stick to developed Asia, Europe, and the US or Americas. So Canada as well. So we tend to try and focus on currencies that maybe aren't going to be as volatile than the South African rand or something like that. I do think that the US, with the amount of debt and money printing that's coming, is that trend on their currency, and it's probably a bit of a crowded trade at the moment, could continue to weaken. So we've tended to try and focus on limiting our exposure there. I think Europe in terms of value is probably a better sector. It's been pretty underappreciated for a long time. So I do think that Europe potentially is a better place for value stocks and maybe getting some exposure there. But right now, I think domestically we've got a lot of potential, and I think our local economy will do very well. So
great stuff.
Why look too far?
Yeah, well, I'm going to wrap it up there, Scott. Thank you very much. I mean, I think it's been some really good insights into how an Australian hedge fund is looking at the world, how they manage risk, how they allocate capital, look at managing drawdown. I think that's some great lessons for basically everyone out there. If anyone wants to get in touch with Scott, if they want to talk about the fund and looking at what they can do there, we will leave some details around that, but the fund details are Fiftyone Capital. But yeah, I really appreciate your time, Scott, and hopefully we can have more chats in the future about what you guys are doing at the fund there.
Yeah, no problem, Chris. Thanks for having us. Much appreciated.
Pleasure. Thanks.